All right, so we didn't get to 9 days in a row. So it's been since 2004, I believe, and since the S&P's had a 9-day winning streak. We've had what 8-day winning streaks since, and all of them have failed. So that's kind of the way it's been going here lately. We haven't had anything more than 8 for quite a while. Over 20 years, it's been almost 30 years since we've had 10 or more. So what we saw today was a pretty, what we saw the last couple of weeks has been a pretty good run, and we ended it with not that really bad of a down day. So that's the good sign of that a lot of these kind of positive signs that we're seeing are still there. Nothing has changed, but again, the weakness that we saw today, especially with the small volume, small range. Still means that we haven't necessarily seen, and you'll see with our trade idea today. Again, we're going to see a lot of signals like we've been seeing for the past couple of weeks in our trades of stocks that are showing us the patterns we want the market to show us. But the market's made such a big move, and sector rotations are a really, really important part of this move. So we're going to break down what's been leading this charge and how much juice that has left in it. So we'll take a look at that and what that means. We'll also take a look at the big driver of the weakness that we saw in late July, early August, and if that happens to be returning now. So we'll take a look at the three big asset classes that have kind of been moving the markets here lately, between bonds, the dollar, yen, as well as commodity prices. So, and then of course our trade idea of the day, again, very similar to prior trades. Nice, good looking chart, what we want the S&P to look like, and we'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, August 20th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I take a look at old trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab here. Click that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. As you can see, again, dark green shading in a green line. The moving average is not moving up higher very much. It actually looks more flat than anything, but it is moving up. That's what makes it green, and you can see the intermediate line is also continuing to move higher, almost into the upper reversal zone again, which is, again, a really good sign. When you get into that reversal zone, that can really get you started on a good trend to the upside, as you saw over here, really as you saw the last two trends on this last year that we've had. Once you get above 80, it's a really, really good sign there. Even if the market sentiment's still in bullish territory, now it might not last as long if market sentiment's already still high, which it is right now, but still, especially if you can start off with a cluster like we did here, or even we came really close to a cluster right there. If you can start off with a good near-term surge, so we'll probably get, at some point in time, this near-term line is going to drop down, if not below 50, below 40, and then we'll see, okay, what happens at that point, right? Obviously, it's a bullish near-term high. We follow up with a bullish near-term low like this, and then we get the surge, right? And same thing here. In this case, you didn't even get down. You barely got below 80. Then we got our surge up to the upside, and it got the cluster. Now, we had a little bit of a pullback later, but that was because of the cluster there. We were so bullish that we were able to do that, right? Have a little bit of a pullback and still maintain a strong degree of bullishness for the rest of that trend. So that's kind of where we're at right now. Again, we're only up 2.5% above the 2.25%. Excuse me. We're not above the 2.5% mark yet. So that's a threshold we'd like to cross. The Nasdaq 100 is a little bit less bullish. The intermediate line is just barely getting into bullish territory. It's still below market sentiment. The near-term line you can see is down below the 90th percentile, but still easily in overbought levels. If we take a look here at the Dow Jones Industrial Average, you can see it looks very similar to the S&P. Intermediate lines crossed above market sentiment. It's moving towards that 80th percentile, and we do have bearish momentum line, but again, it doesn't really matter unless it's at extreme lows there. So we don't have any issue there yet. And then finally, your Russell 2000, you can see it's even less bullish than the NASDAQ, as the near-term intermediate line is still in the lower half of the chart. The momentum line did drop to oversold levels, which opens up a little bit of a concern there, as the near-term line is dropping out of the reversal zone. So a little bit more bearish on the intermediate basis, as well as the market sentiment line. That's the lower market sentiment line of all the major indexes. But it's also more bearish on a short-term basis, as that's a deeper drop on both these lines than what we saw. We were down more than 1% on the Russell 2000 today. So that's kind of what the market forecast charts are showing us. Let's take a look at the weekly chart. And again, you can see the strong weekly candle that we continue to have. That's good. Let's take a look at the 3 green arrow chart here, and you can see 3 green arrows again across the board, except for the Russell 2000. So again, we only had a day. Now, granted, we could turn right back up tomorrow and get right back to 3 green arrows. So, but as of right now, that's not the kind of, we don't like to see 3 green arrows for just one day and then never come back. So it's really important that the Russell rebound. You can also see the Q still doesn't have a green line yet on its moving average down here. It's still yellow, which means that the moving average is still falling, despite the fact that we're above it. And you can see all the histograms for the NASDAQ, the S&P, and the Dow have all started to move lower. We'll see if that's just a one-day phenomenon or not. Let's take a look at the 2-line versions of these charts, and you can see that histogram rolling over there. The MACD is still very strong. Stochastic still very strong in its bullish territory. You can see that we are still well above these moving averages. The 8 and the 17-day will be crossing above the 30 here within another day or so. So that's all a good sign. Your Russell 2000, remember, is the least bullish, and it's still flirting with that 30-day moving average, with the 8 and 17-day still flirting with getting above the 30-day. It's still down at the bottom or down below it, with the MACD there hitting right about at 0, and of course the stochastics also in the lower half of the chart, still barely, and the MACD histogram already rolling over. So not nearly the same degree of momentum that we saw on all the other indexes. If you take a look at the DMI, you can see we're still not quite above 30 yet on the S&P 500, as well as the negative indicator is still not below 20 yet. So still not quite getting the indicator we would like to see, the pattern we would like to see there. Of course, IWM, you have both lines right now below 25, so it's brought the ADX line down below 20 again. So very short-lived trends, both on the bullish and the bearish direction. And then, of course, now moving up slightly higher with that light green shading, but that's now even gone, as we have dropped back below 20 on the ADX down at the bottom. If you take a look at the RSI and the CCI, again, we are above 60, so we are green, but we're just barely above 100, still not above the 150 mark that we'd like to see to signify a new bullish move starting. The Russell 2000 is above 50, still hasn't crossed over the 60 level yet, and your CCI also is at kind of failure level. So we do need to get a little bit more of a run here going on the Russell 2000. Of course, according to Tom Lee, we're about to get one of the most bullish moves ever in the Russell 2000 in the next 19 weeks up to the end of the year. 40% gain is what he's calling for between now and the end of the year. So we should, if that prediction follows through, we should get above these levels. But that's what we're going to need to see if we're going to break above 2200 and work our way up towards higher levels. Let's take a look at the Ichimoku cloud. Of course, the S&P is above the cloud, just barely, but it's above the cloud. Right now, it's above the pink level. Again, we're not to it yet. We still have a few more weeks to get there. So we need to be in this area or better by the time we get to 9/11, right about 9/11. So we'll see. At least the cloud has turned green. barely, but it has turned green, and we are that close, being above 1 and being above 50. We are that close to having a new bullish trend starting. A weak bullish trend, but a bullish trend starting nonetheless. If you look at the Bollinger Bands and the Keltner channels, again, we are in the upper quartile, but just barely. The bandwidth is still relatively high. Still not outside the Keltner channel, but at least we're close to it with some very strong positive momentum coming off of some very strong bearish momentum. If you look at the 4-week range, we did get another new high today, but it's a very, very small range. Obviously, not very much volume either. We did not close up above yesterday's high point. Can't really see that very well, but here we got up above it in the morning, got the new high, but then closed below yesterday's high by the end of the day. But at least it was a higher high and a higher low, and we did get a second day. Again, we start to worry when the green line drops below 70. In this case, we jumped to 100 at the same time as the green line dropped below 70. But we start to worry about, if a new 4-week low point developing once the green line gets down there. And the more highs we get, the less likely it is to get down there. And also the red line has to typically hit 0, and of course it's a long ways away before we get to that point. Let's take a look at the volume and the trading range. So you can see the volume ended up being really, really light. 33 million shares trading hands. The range today was 3.5 points. Both very small numbers, but again, good signs for the market because we want very small numbers. That's what brings these averages down, and the markets are bullish when we bring those averages down. So that's all very good signs for the market as well. And then finally, your VIX jumped today, has been on its way down, jumped 8%, up over a point, up to 15.88. Back above the 85% mark, but still at good, strong, bullish levels for risk appetite down here, below 90%. And the VVIX is up, but it didn't go up very much, considering that the VIX went up 8%. The VVIX only went up to 101, so that's not a very high level at all. So even though the VIX is up, I wouldn't put a lot of stock into it, and most likely will continue its path lower. At least the VVIX will continue its path lower back to where you saw it's been for the bulk of the year, where the VIX can also get down and be there for the rest of the year as well. All right, now let's talk about what's driving the price action today. That's again a very small range day today, so not a whole lot of movement. But let's take a look at what we got here. So we'll go to the intraday chart. You can see bonds were the best performer today. Interestingly enough, stocks were down, but not very much. IWM, of course, was the biggest loser. The dollar was down quite a bit, and commodities were down. So interestingly enough, remember the three-headed monster that we had that really put a lot of pressure on equities in 2022 was the dollar, commodities, and yields. They were all moving higher, and all of that, equities were falling during that period, as we all know. Well, now you can see they're all three moving lower, and as of today, with all three down today by a pretty significant amount too. These are all pretty decent moves, but none of them pushed equities higher. In fact, like I said, IWM was down over 1%. Gold was up. Global bonds were up, but treasuries were up quite a bit. If you take a look at those three asset classes, let's take a look at them here. First, let's take a look at the 10-year yield. And you can see it's been moving lower. And you can see it's been moving lower for the past however many weeks since April. We've been headed lower here, and we're kind of missing. It looks like we're missing some weeks on this pattern. Let me see if I can get this chart over here and see if it's not missing all those. Where is it here? And then we'll go out to a 20-year time frame weekly chart. And then we'll do TNX. And looking like it has all that. So, okay, so after peaking in April, the second to last week in April, it's been on a pretty steady decline ever since. In fact, we're below 30-week moving average. The 8 and 17-week moving averages are falling. We just continue to move lower. In fact, again, on August the 5th, we closed as we drop down that these 2 weeks. The equities are down these 2 weeks as well, these 3 weeks actually, but these 2 weeks especially. And then you can see on August the 5th we started off down 2, and now we're pretty much at those same levels. If you look at the dollar index, the dollar index had also been dropping for a while, really dropping since June, but you can see that peak in April as well, and it's been dropping ever since, again below the 30-week moving average, working its way lower. As you can see, like the US dollar Japanese yen is breaking its 50-week, moving towards the 200 with a big gap to fill it there. The euro US dollar, these are the two biggest components of the dollar index, breaking above its 200-week moving average this week for the first time since the middle of 2023 when we had that failure there. But we're breaking back up above it again, a little bit more of a concerted move to get there this time. And then, of course, commodities. When you take a look at commodities, they're also moving lower since earlier this summer, really since the beginning of July. But here's that end of April. We kind of peaked there at end of April. We just retested it a couple of times, but you can see how we're moving lower. So if I were to go back, let's see here, so it'd be starting on the 29th, on April the 29th going forward. We'll move this out. Again, this is where all three of those asset classes are kind of moving in the right direction, right? In this case, moving downward. We'll see what effect that's had on these three. So there's commodities down, the dollar's down, and then yields would be down with TLT up. You can see real estate's really benefited from yields being down. The equities have really benefited with 10% gain in the S&P 500 and the Qs. IWM had been kind of trying to match up. It's still doing pretty decently well. But of course, again, commodities and the dollar really falling down, and it doesn't look like the dollar, like if you remember the biggest culprit for a lot of this weakness that we had here recently was the US dollar, was the yen strengthening. Remember the Nasdaq peaked on July 10th. From that point forward, the Nasdaq's been falling. And you notice, like, here's August the 5th. Well, you notice here we are almost right back to the August 5th level on a closing basis. Maybe not on the low, but on a closing basis. We are not back to the August 5th level on the S&P 500. If I were to do a comparison chart here and take a look at the S&P, now you can see we also fell on the S&P 500 on August the 5th, and we also started to rise all the way through August 15th. But from August the 15th forward, you can see the yen's really taken off in 3 days, and stocks have stayed pretty bullish in that 3-day period. So you can see how things are starting. That the yen is starting to regain some strength, and it hasn't quite shown up yet in the same kind of move that we saw on equities during since that peak on July 10th. There's the 3-day move where the dollar's really dropped. We'll look at commodities have really dropped too, and gold has really taken off to the upside, and bonds have really taken off to the upside, and yet stocks are still up 1%. So it's like a safety trade to a degree, and the question is which one? Like, who's gonna win this? Is the dollar going to keep going down? Because if you notice, I brought this up on Twitter. If you notice here, if I were to go back to 2007, 2008, when the Fed started to cut rates, when yields started to fall to price in the Fed cutting rates, kind of like what they're doing right now, that was in June. That's when yields really started to fall. They started to cut rates in September, right here, and then they didn't finish cutting rates until December. That was the last cut down to 0%. So they cut rates this entire time, and you can see the yen just took off at that point. You can see equities also didn't do so well, and obviously we went to a bear market. That was the last cut cycle that we've had. Obviously we had a little short-term cut cycle here in 2019, but it was just a couple cuts, nothing too major. This was the last extended cut cycle, and the yen just took off, and you can see right now that the yen is very bullish. The dollar had been very bullish again. The yen is extremely oversold, And if that, here's the gap between the 50 and the 200-day moving averages. If that continues, that carry trade continues to unwind, we saw the impact it had just over a couple of weeks on the S&P 500. We'll see what kind of impact it has if it's similar to what we saw in 2008, where we started to fill in that gap there, and that pretty much started the correction. This was the correction phase of the bear market at the end of 07 going into early 08. The failed correction bounced there into May of 08, and then the bulk of the bear market there. We'll see if we're into that particular pattern, because we have a lot further to drop there than we do now. And again, the difference between now and then and this 2016, where we also had that same pattern, is yields were falling, and yields were falling now, are expected to fall now, as the odds for rate cuts continue. In fact, the odds for a 50 basis point cut within these first two meetings is now up to 53%. So again, up from 39% what we saw yesterday, and now it's up to 53%. So the odds of that second cuts, but in the third cut within the next two meetings, so a 50 basis point cut in one of them, even the odds for a 50 basis point cut jumped up to 1 in 3, from 1 in 4 to 1 in 3 today. And we'll see with the minutes tomorrow and the Jackson Hole speech afterwards. We'll see if I think that's what the market's going to be looking for to see. And right now, the bond market says there's really only going to be one cut, and really that's it. But the futures market and everything else is telling us there's most likely going to be more, as, again, I've mentioned to you before, the wide gap between the 10-year and the 3-month suggests we have a lot of cuts left to go just to get it even, much less get it back to normal levels. Let's take a look at how the sectors are performing. We'll take a look at on the past 3 days, again, where the dollar's really dropped over the past 3 days. So we'll go to the sector comparison chart and then go to the August 16th. So this is the last 3 days here, where the dollar's really been down quite a bit. Commodities have also really been down quite a bit, and yields have been down quite a bit. And you can see the three horsemen, right, are doing the best. XLY, XLK, and XLC are outperforming the markets. You do have healthcare and staples and utilities outperforming the other cyclical areas in the market. There's industrials, materials, energy, financials. So, so your big mega cap names are acting as safety trades themselves right now. It's more so a safety trade than anything else. Remember, going all the way back to July, when the yen started to break down relative to the dollar, you can see how utilities, real estate, staples, healthcare have all been the best performers. Industrials and financials have all rallied here lately. As the markets rallied, they've rallied too. But you notice these three are still underperforming the market since that period. So part of the reason why they've rallied so much is because they were such significant underperformers. And now they're catching up, but there's still a lot of catch up to do if they're going to get back to those same levels. And I think most of the move that we're getting right now in those areas, especially in XOK, is just that. It's nothing more than just an extremely oversold bounce, as you see with I've shown you this before. I showed this yesterday, I believe. The big move higher, big momentum move higher, but it still hasn't got the ratio of XLK to SPY above its 50 days. If you notice the ratio chart here, XLK, so you can see QQQ is up against IWM, but not quite above the 50-day yet. But if you look at this ratio chart of XLK above to SPY, you can see it hasn't broken back above that 200-day moving average or the 50. So it's a big move higher, big momentum move higher, but only because the relative strength was at its lowest level ever, and we were so extremely oversold. We were so far below the 50-day that we've made it such a strong move to not even get us above the 50-day. As you can see, we're above the 8 and 17-day, but we're not above the 50-day here. So it kind of goes to show, are we going to have enough momentum to keep us going? Or, as you can see, momentum's already starting to wane. Now, are we going to eventually get this 50 to 200-day MACD to cross below zero. That's the big concern, as we are at failure levels for the ratio and all these other indicators, suggesting that we will most likely run out of gas here as the relative strength line approaches 100, with the momentum line rolling over. Usually when it rolls over from such high levels, we can get some pretty significant momentum back down to the downside. So we're hoping that before it does that, it can stay bullish enough again to get it all the way over here. Here, if I were to go back the 10 days, this is I guess it would be 11 days since that low point on Monday. There's the move. There's that big move higher, and it's really picked up the pace here recently. Same thing in XLY, was everything else has really rolled over to the downside, coming off those lows. And it's such a dramatic move. Is that enough to change? Because right now, on a weekly basis, you can see the weekly chart is showing a strong move towards safety, with utilities coming back up towards the leading category. Healthcare, staples, real estate all moving up as well, and you can see some of these other cyclical areas moving up, including financials, industrials, materials, and energy, all starting to move up too here. Let me just do. It's not going to let me see. It'd be nice if I could. But there's financials, energy, materials. There we go. Those other cyclical areas again that are negatively correlated, right? When you look at financials relative to the S&P 500, financials relative to the S&P 500, and look on our weekly chart, right? And then we'll come down here. You can see the correlation here. Let's zoom out so you can see that correlation a little bit better. Let's zoom out to like a 10-year. So you can see it's generally, less bullish and more bearish, more below zero. Now, not as strongly bearish, but still it's not, something that's typically strongly bullish, not nearly to the degree that, say, technology is. Let me show you the difference here. You can see it is strongly bullish and is for most of the period. So that's something you do want to lead the way higher. Again, because of the sector weighting, this is not something, whether it's financials, whether it's industrials, this is not something that we want to be leading the markets, as it's typically more negatively correlated. Same thing with energy, of course. It's more negatively correlated with the markets, and materials as well, more negatively correlated with the markets over the long term. So those are the ones that are all moving up to the right on a long-term basis, even if right now they're getting a short-term swing down to the left. So how long this lasts, especially with the speed of it, you would expect that it probably won't last very long, that we've probably used up all of our momentum just to get to this point, and won't have enough to get us through and start a new bullish trend up to the upside. For an example, like by the time we got to this point, you can see the relative strength was above 100 and we were above the 50-day average when you had a similar type of move as we had right now. Same thing over here. When we had the similar type of move and starting a new bullish move, the relative strength was above 100 and we were well above the 50-day average. Here we're still below the average and we're still below 100 on the relative strength line. So that's kind of what we're talking about there. All right, now that brings us to our trade idea of the day. It's actually in the communication services space. Here, let's take a look at the market forecast chart for Take-Two Interactive. It's also rebounded really nicely. It's gotten above its moving average. You have dark green shading in the green line. You can see the intermediate lines rising in bullish territory. Strong bullish near-term run. We're 4.5% above the 30-day moving average. We've crossed above market sentiment, so all really good signs from that perspective. The weekly chart looks really good. We've avoided a death cross for the most part since April of 2023, despite the pullbacks. And now it looks like we're reversing back up to the upside. A good weekly candle back above both the 10 and 40-week moving averages. Obviously, you're going to have 3 green arrows here. As you see, 3 green arrows and a green line. We had some pretty decent volume today on that 3 green arrow signal. And if you take a look at the 2-line version, we are breaking up above the 250-day moving averages today. So that's a good breakout. Strong MACD, strong stochastic indicators. When you look at some of the other oscillators like the DMI, it is showing a good pattern here. Not quite below 20 yet on the negative. Again, there's not a whole lot of indicators, stocks that do have that below 20 because of how bullish, how fast this move has been. But we are above 30 on the positive indicator, so your ADX is slowly starting to rise down there. If you look at the RSI and the CCI, it is showing us what we want to see. On the S&P, right, we got some break above old highs. You're above 60, you're above 150. Perfect, exactly what we want to see there. If you look at the weekly CCI, we were below minus 100. We're starting to make our way back up towards the positive 100 level, which would be a good sign as well for this stock. Let's go to the Ichimoku cloud. We are flirting with getting above the cloud there, as we are now about to approach the pink shading of this decline that we've had. We're still a long ways to go. Like, and you can see we're almost a week bullish trending levels. So that's a good sign as well. We may just be beginning a new bullish move on take two, and you can see we're also into the upper quartile for the first day, breaking, which is a very high Bollinger Bandwidth, and we got some strong momentum to the upside. So you have an opportunity to kind of build on this bullish move. So what I decided to do here was to sell that mid-30s delta. 160 is a strike, buy 157.5. In this case, going for the typical $500 risk that we do for our directional trades, getting about a 2-to-1 reward to risk ratio, which is exactly what we like to see there. So that's our trade idea for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at marketscholars.com for free, follow me, and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.